Exchange traded funds and regular mutual funds. What's the difference? That's what we'll be talking about today on Friends Talk Financial Planning. And by the end of this episode, you'll understand both what we think you should pick and why we brought this up. In my opinion, there's a significant new offering that maybe you should be thinking about. So I'm Bridget Sullivan Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. And before we dig into exchange-traded funds versus mutual funds, I want to remind everybody to hit that subscribe button. Subscribing to our show helps other people find this content on YouTube, so hit subscribe, and then let's get into talking about exchange-traded funds, or ETFs, in our language. And it seems like ETFs are a fairly new thing in the investment world, but really they've been around for a long time. And why don't you start the conversation, Bridget, about how to think about these things?
Yeah, when I'm explaining this to clients, what I say is that when mutual funds first started, a company would set up a mutual fund and everybody would send in their money, and then the mutual fund, at the end of the day, they'd invest it and they'd figure out, okay, what's it all worth? And people would send in their money and they'd send in, okay, I want redemptions. We want to take some money out. And every night, the people at the fund company would put their heads together and figure out, okay, what is the closing price? How many people are coming in? How many people are going out? Okay, and then they come up every night with the price at the end of the mutual fund. So these started, as far as I know, in the 70s, regular mutual funds. Okay, but probably go back to the 50s, but maybe I just didn't hear about it. Okay, so then computers start getting better. And there's a demand for something that's a little more current, all right? And so then what happened in the 90s is that the professionals, decided to start experimenting with funds that are traded on the stock markets, on the New York stock market. So you can, instead of sending your money into the company, it's there and you buy it just like a stock. And so you can, instead of sending your money into the company, you have an agreement with your brokerage house, say Schwab or whoever, and then they go ahead and buy it on this stock exchange, again, just like a stock. It took computers being better for this to happen so that the computer can figure out, okay, exactly what is this worth at all times, and then for buyers and sellers to have a ready market for these basket of funds or a basket of stocks in the market. Okay, so started in the 90s, mostly for professionals, but then other people wanted them, and there was enough trading on them so that there would be a ready market for them, and there wasn't a big spread between the buy and the ask. And so then they became just generally accepted. I know I've started my practice in 2008, my financial planning practice, and we've been using them. That was right around, pretty close to when Vanguard started offering ETFs, and so we've been recommending them since the beginning. Done. Okay. What do you think? What do you tell people?
I tell people that Bridget's a lot smarter than I am because she understands all that background stuff, right? I started my practice a few years before Bridget's. We started with mutual funds, and now most of our new investments, at least in the brokerage side, are in the ETFs. And really, my memory of what went on with as ETFs were touted originally, as I remember it anyway, as something that you can buy a mutual fund, but mutual funds only trade at the end of the day. So if you want to buy a mutual fund right now at whatever time it is you're watching, it's a close of business either today or tomorrow if it's at night. ETFs, as soon as you buy it, as you describe it, buys like a stock. So you can buy in and out whenever you want to. Well, that doesn't sound very exciting to me. Like, who cares exactly when you get the purchase price unless you're timing the market, which we don't do and don't recommend. The advantage that we really saw in it is that the ETF, the way they structure that compared to the mutual fund, is that at the end of the year, mutual funds are required to distribute their profits inside their fund to shareholders. If you own mutual funds, you might get those 1099s at the end of the year, and then you have to pay taxes on your capital gain distributions. Even if you didn't sell anything, ETFs, generally speaking, don't have that. So a very similar underlying, we have these professionals managing the funds, but it's much more tax efficient. And that's the real reason that we use them today for folks, is that this tax efficiency, not having every year these big tax bills when you have mutual fund distributions. So that's a real advantage, or where we see it in practice. And as I look at it, the funds that we use anyway, and I know you use a lot of similar funds, is there's an underlying index type fund. The mutual fund, I'm talking, the ETF version has basically the same management, the same philosophy as I look at it. And it's not the case for all ETFs versus mutual funds, but for the ones that I use anyway, it's mutual fund, ETF, it's talking, the same, this type of apple versus that type of apple. It's not even apples to oranges. It's apples to apples, just a little different flavor, one that's a little bit more tax efficient. We're getting the same investment with a bit different tax wrapper around it. So that's largely how we think about it, even if the technical details are a little bit off from that.
Yeah, and I would say that you still will get dividend distributions, and so you'll still have to pay tax on some, even with the ETF, but you don't have to. It separates out the capital gains part, and so then you have control over that. Mm-hmm. When am I going to take that capital gains part, or maybe there's an advantage to doing tax loss harvesting when the stock market's down like now, that when you have a mutual fund, a regular mutual fund, you don't have that same opportunity. It's more baked into the actual fund, and less you have more control over this big element of the mutual fund. Again, you don't have as good control over the dividend part, but you have a lot of control over the capital gains part. And I think over time, a lot of times the capital gains part is a bigger factor than the dividend part anyway.
Here's how I describe this. Is really interesting to have this look behind, like we have a conversation, just the two of us, is I find people don't know what an ETF, it's like I'm talking a foreign language, exchange traded, what is that? But people know mutual funds, right? And you go back into the 70s, people, what's a mutual fund? You buy stocks. Well, everybody kind of knows, oh yeah, a mutual fund. I explain it to people, say an ETF is pretty much just like a mutual fund with some technical differences that benefit you, right? Is that a fair explanation, do you think, for what it, as for a regular person, to talk about viewers here, it's like a mutual fund, but it's just slightly different for some tax reasons.
Yeah, I would say that's fair.
Okay.
I would say another thing about mutual funds is that's, as far as I've seen, what is available in 401ks. Yeah. So I'm not exactly sure why 401ks are not. Maybe it's because they don't want people trading all the time. But 401ks typically have traditional mutual funds in them.
Yeah, there's got to be some technical difference of the execution or something, right?
Yeah,
that comes into play.
Yeah. So I end up looking up the old mutual funds because of the 401ks.
Got it.
And then there's some there's some investments that are only available in mutual fund form, and they're not available in exchange traded funds. And sometimes it's because the outfit that is putting these together don't want them traded that much. I would say, so one of the things that we wanted to talk about is what even sparked talking about this. And for me, one of the, we use dimensional funds a lot, and Dimensional Fund Advisors has started putting out exchange traded funds. So Dimensional Funds Advisors funds have not been available to the general public. It's only been available through advisors like us. We both offer them. And I'm not promoting Dimensional any more than I promote Vanguard or any other mutual fund. But I will say that they haven't been available before. They are available now, and they're worth a look. I would say also the one particular fund, if you're interested in this kind of thing, that's worth a look, is their exchange traded fund for sustainable investing. Again, I'm not recommending that more than any other, but it's something that's new on the market, and they've had a long history with sustainable investing with a regular mutual fund, and this particular type philosophy that they use hasn't been available to the general population only through people like us before that. So that's what got me thinking about this. I was like, wow, this is actually big for the industry, that these are starting to be available.
I wanted to pick out just a couple of things that you said in there in talking about And we talked a little bit before we hit record here, is there a reason why you would use a mutual fund versus an ETF, especially in a taxable account? And as far as we can figure, the answer is no. Like, the ETFs are generally preferable. One key exception is if I can't get that
Right.
type of a fund I want in the ETF version, then it does make sense to have the mutual fund version. What you just described with the dimensional sustainable funds, and you're a great resource on that. For I know for me is, and I don't mean to put words in your mouth, but DFA does a really good job of producing sustainable funds investing, right? So this is what I want to do. Before this, no ETF version, so golly, it makes sense to have. Even the tax efficiency might not be what we want. Now we have an opportunity to say, well, golly, if you really think that their sustainable strategy for investing makes a lot of sense, now you've got this opportunity to do that, right?
Right. And I want to make clear, I don't want to recommend it, but I do say it's worth taking a look. The other thing we haven't mentioned yet is that the fees are typically a bit lower with ETFs versus mutual funds. So that's why even in IRAs and Roth IRAs, where you're not worried as much about the capital gain, like exactly what's capital gains, exactly what's dividends, it doesn't really matter that much in those accounts. Still, the fees are generally lower and than mutual funds because, again, now I think the reason is because it takes away the burden of the record keeping off of the people who are managing the funds and puts it on the more efficient markets, like the more efficient stock exchanges. And so they pass along that savings to you. Although it seems to me that the cost of mutual funds have come down, partly probably because of the competition from exchange traded funds.
Yep. I think it's maybe a great place to wrap up and thinking about when you hear exchange traded funds or ETFs, think it's like a mutual fund, probably some more tax efficiency, a little bit less expensive, and it's something that's worth taking a look at from that standpoint. So with that, I'm John Shearer, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Marmel, and I've got a fee-only financial planning practice in Chicago, Illinois. We're both members of ACP, or the Alliance of Comprehensive Planners. If you're looking for an advisor in your area, you could check out acplanners.org.
And don't forget to hit that subscribe button.